Hey, it's Mike, non-investment guru, just an average guy sharing my investment journey on the internet. In today's video, we're going to discuss using yield max, specifically Tesli, to enhance gains in your portfolio. I am using margin to invest in this covered call fund, and we'll see how the performance is so far. I've personally been owning it for 3 months. One of the key pillars of doing this yield max strategy is the distribution yield is immense. So we have a distribution yield of over 49.5%. And the reason this strategy works out, because if I'm borrowing at 8% and I'm getting a 49% distribution yield per year, then in the long run, I should be squeezing out some extra gain by using margin. So the margin would essentially pay for the interest, as well as you can invest in other holdings, or you can reinvest back into this stock or this holding. Me investing in Tesli is not some crazy idea. I've been investing in covered call type strategies for quite some time now. Predominantly in 2020, I was selling covered calls and cash secured puts on Tesla. I made a substantial amount of money, but the only problem is I was overextending the amount of leverage I was using, and I got burned. So moving forward in this strategy, I am actually only using less than 5% of margin in this account. So you can see my equity here is overall $224,000, and I'm currently only using about 4.4% of margin. And that's just to protect myself, or protect, my holdings, to make sure that, I don't get a margin call. So if I did get a margin call, they say that I would go down to this portfolio would have to drop to $89,000 before I would have to start selling assets. And you can see here that I have a very low margin risk. And then the buffer, I have 59% before the stocks can drop. And then my daily interest rate of this 8% is $1.89. So going over the actual metrics for Tesli, I own 694 shares of Tesli. It has a very incredible maintenance requirement of only 25%. So for example, if I invest $1,000, that only takes up about $250 of the maintenance requirements, which is pretty strong, knowing that some other covered called funds require much higher maintenance. I will say the expense ratio is a little expensive at 0.99%, but I am totally willing to outsource doing the covered call strategy that I would have done myself to a professional. And to me, that's a very nominal loss compared to doing a strategy that I was already going to do myself, but then having someone else do it who knows a lot more than me. So to me, that makes a lot more sense to do that. So just recently, I got paid $386.03 from Tesli, this yield max covered call fund. And I have the drip turned on, so I'm dripping the money back into the shares to buy more. So my average cost is about $16.98. Currently, the share price is $14.28. So I'm definitely taking a loss right now. And that loss is about $1,877. But if you factor in the $386 that I got from the income, and you would factor in perhaps getting something similar to that every single month, maybe a little bit less, a little bit more. And then after a couple months, you're pretty much even for your return. Now, this just doesn't really tell you how much you're actually getting in terms of gains. So I just created this spreadsheet here that tells us what our gains are here. I initially started mid-July in investing in Tesli, and I actually owned a whole bunch of other yield max funds. And then again, realized that I only wanted to stick with Tesli. It had the highest distribution, especially for this strategy to work. If I'm paying an 8% interest rate and I'm getting over 40% in distributions, that strategy makes sense. But if I'm only getting 8%, if I'm paying an 8% margin rate and I'm only getting 7% in a covered call fund like JEPI, that makes no sense. So just kind of like looking at these numbers here, I combined July and August because when I bought the holdings in July, I only got paid out like $57 in total income. So then I just combined the July and August. So that payment was $664 plus some expenses. Now the September number. So this is where we're at right now. So total fund value, $11,312.40, or that's how much it cost. This is the margin amount. And then how much margin is of this is only 84%. And then the total amount that I got paid out this month in September was $386.03. And then I'm going to be paying my margin interest tomorrow, but I've calculated that with the $5 Robinhood Gold plus the $42 comes out to $47.44. I will adjust this accordingly when the actual margin gets charged to me tomorrow. So if I'm getting paid $386 in income, subtracting this, and then I'm accounting for some taxes here, this is what my net gain is. I made the mistake in 2020 when I made tens of thousands of dollars selling covered calls with immense amount of margin. I didn't account for taxes. So then I believe in 2021, I had to foot about a $20,000 or $30,000 tax bill. Had I known what I know now, I would have just set the money aside while I was making the money, but you live and you learn. And moving forward, since this is a covered call strategy, you're getting paid income. This is not qualified dividends. This would be taxed at ordinary income. I would fall under a 24% tax bracket plus my state income tax, which is like 5 or 6%, puts me at a 30% tax rate. So what I did is I took the amount of money I made, minus the expenses, so the Robinhood Gold, minus the interest, and then I multiplied by 0.30 and I got this number. So I'd have to set aside $101.58. So then the net gain is $237.01. So overall, puts us at a monthly yield of 2%, which is actually a pretty good number. So if you're getting 2% every single month for 12 months, that's 24% return after taxes. That's a pretty strong percent. So for me right now, doing the strategy is worth it. Now, what happens when the stock market drops and the volatility? I guess if the stock market drops and then they're not paying as much premiums, I did account for premiums going down. As long as the total gross income is just covering the margin expense, to me, I don't mind it because then I can reinvest more money back into this. But for the most part, getting an extra $237 without having to, roll options, have to do it yourself, to me seems like a pretty good deal. So those are my thoughts right now. And again, it's really hard to tell the adequacy, how good a holding like this would do. There's inherent risks when you invest in covered call fund. You're going to get some capital will depreciate over time. And, I accounted for that. As long as your holdings, I wrote it here, at 10% yield, you need to reinvest 25% back into principal for capital preservation. I've run many different calculators to see if this type of strategy would work. So to some degree, I might add another column in here, subtracting the amount needed to reinvest back in to keep getting capital gain as well as the income. But I just want to see how it turns out right now. But, for the most part, up until January, I'm going to be reinvesting every single cent that this fund pays out back into the holding. And then, we can decide what we do with it. But that was these are my thoughts on it. So far, I like what I'm seeing here. Getting a 40% distribution, 8% margin rate. That to me seems like a no-brainer to get a couple extra percentage. You're definitely increasing your risk, but with having to only pay a maintenance requirement of 25%, and again, using only 5% margin for my portfolio, I think it is a great way to enhance a little bit of gain and allow it to squeeze out a little bit more profit from your portfolio. But those are just my thoughts. Hope you have a good one.